Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, Mention, and other fine folks, to the Sunday Dispatch of the Black Letter, where we contemplate thoughts worth thinking. And today's thoughts have to do with the stock market and how we can perhaps try and eke out a small cushion for our own investment or savings that we are investigating currently. There's been a big uptick in savings recently. I've read that I think in April or May there were 33% savings rate amongst the general American public, which is huge. Obviously, as we've spoken about before, people are feeling a little bit concerned about the future. And when that's the case, people are going to save their money that they have, either from the stimulus check or from work, if they still are lucky enough for that, and perhaps even from the additional bonus that some folks are getting from unemployment benefits, the extra $600. So that's something to bear in mind. I've been involved in the stock market for quite some time. Through the 2008-2009 financial crisis, I wasn't involved per se back in the dot-com bubble, which was a huge crash, and neither was I in the 1929 crash either. Obviously, not many of us were, but of course we like to look at that period to seek perhaps some historical truths from it. It's hard to tell though. So we've got a couple of articles here. Let's look at what I'm doing now and how I'm thinking about this particular stock market that we're in and the economy that we're in, and how I'm trying to perhaps hedge for a better future for myself and my family. So here we have the New York Times. Repeat after me: the markets are not the economy. The two have been intertwined in the American psyche since the 1929 stock crash and the onset of the Great Depression, but stocks are not a reliable gauge of overall economic health. That's quite obvious if we take a look here at the Dow Jones, for example. In the past year, you can see how it's been doing. It's up at around just over the 61.8% Fibonacci level from the high, and it hasn't quite reached the 200-day moving average. But these are historically this is historically quite a high value for the stock market at the moment. And if we take a look at the S&P, for example, we can see that it has certainly breached and has closed three times daily above the 200-day moving average, which would suggest that perhaps that's a significant level and will continue to move up from here. Currently, I'm short the S&P 500, losing my shirt quite quickly, as you can imagine. But I think this market is just lost. Not only has it lost any sense of reasonableness, but it certainly has become detached from the economy on Main Street generally as well. Let's look what else the Times has to say. Yet stocks keep climbing, as we've talked about, even as 20.5 million people lost their jobs in April. The S&P 500 stock index logged its best month in 33 years. I think eventually the stock market has to represent the economy to some degree, because it is money there is invested in the biggest companies in America. For example, if we're talking about the S&P 500 or the Dow Jones, the top 30 large industries represented by individual companies. And those companies in the S&P 500 or the Dow Jones are not going to be able to continue to excel when the rest of the economy is in the toilet, basically. I mean, people are saving money, they're not spending, and this will probably go on for, at least another couple of years or so. People say, well, the stock market is not the economy and blah, 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 and don't fight the Fed, etc., etc. I think we have to fight the Fed, really, because they have lost their mind. They're doing nothing but putting out stimulus and printing money that's primarily going to the top 1 or few percent and their cronies. We have BlackRock now buying up bonds, for example. They're into ETFs, buying up actual ETFs from the stock market, junk bonds, and folks are thinking that eventually they're going to start actually buying stocks directly and perhaps through ETFs. I'm not sure about that, but really then we might as well go to a communist environment, really, and have our fearless comrade leader, the president, start dictating which businesses should survive and which shouldn't. We have long ago, probably since the 2008 at least financial crisis, we've long ago lost the free market that we had, and I think it's going to continue to have big repercussions in the coming years and decades. But in the meantime, we have to make do with what we have and how to best manage and keep the small savings best we can. As my grandmother used to say, you always want to squirrel a little bit of oil away for your lamp. In other words, you want to have a little bit of savings. We know this to keep ourselves afloat during tough times, and we're going through exceptionally tough times right now. Let's carry on with this article. Wall Street has very little to do with Main Street, said Joaquin Clement, a market analyst at Liberum Capital in London, and less so. Now, that may be true, but businesses have to earn a profit, and if the profit starts going down and they can't continue to keep their sales growing, then of course the market is reflecting outsized valuations currently. And that's what I would argue. People say that, well, the market is forward looking, and you can see that the market is looking 6-12 months out. Well, if that was the case, then how come, let's say back in the early fall, around October or so, how come the market didn't crash then? If it was so forward-looking, why didn't it realize a pandemic was coming? So I think that's all balderdash, frankly. The market is just a hive-borg mind, if you will, and as such, it's emotional. And it currently, right now, is definitely going through a period of insanity, and it's quite concerning. So I think the best approach for me, anyway, is to sit on the sidelines, although I haven't done that, and perhaps look at other options to hedge my income as we go through these unprecedented times. We don't know if we'll have deflation or inflation. I think it'll be deflation first, then inflation. But in any event, let's have a look what else is happening here. Through the end of April, these companies were up roughly 10% this year, while the 495 other companies in the S&P were down 13%. And we've seen this. This is unprecedented, except I think back in the 1929 crash, where again, 5 top companies, or 4 of them, there's charts out there that show you how they were. And maybe we'll take a look at those charts, but you can find them online, where the Dow Jones, I guess at that time, was heavily, or the market in itself was heavily driven by just a handful of stocks. And here we go, seeing that again. So these valuations are quite excessive. Stock ownership among the middle class is pretty minimal. So again, all this money printing, all it's doing is helping the 1%, those that have the resources and those that know how to invest in stocks and that kind of thing, and bonds, and this is where it's happening. So in fact, a relatively small number of wealthy families own the vast majority of the shares controlled by US households. The most recent data from the Federal Reserve shows that the wealthiest top 10% of Americans own about 84% of the value of the household, and the top 1% control 40% of household stock owning. So this is really where things are going. Folks are really focused on, at least the money printing and all that, on helping their wealthy buddies. And so what are the rest of us supposed to do? Well, I certainly am not going to get into the stock market right now. I have a tendency to believe, and this is why I'm short the market, because I think it's going to go in for another crash at some point, and maybe it won't, and at some point I'll have to cry uncle and get out of the market and sit on the sidelines. But in the interim, what can we do? We want something that will be able to grow in value, or at least hold steady without a great chance of a crash. Now, there isn't much there that'll do that. For example, one of the things to do would be gold. And so here we have the gold price, as you can see, plotted on the chart going back about 5 years. And as you can see, it's really at quite high levels, the highest level in 5 years. Now, gold has often been a hedge and a store of value that has held up well, generally during crises and against inflation. But at the moment, we can see that, in my opinion, gold is a little highly valued. Now, it could have a lot more to go as perhaps this pandemic unfolds, but gold is difficult to use as a hedge too. It's difficult to chop into smaller pieces, to make any payments with, to transact with, although it is a good store of value, and it has shown its potential over the millennia, as it's always kept up its value. Incidentally, a good sense of what a reasonable value for gold is that I've heard is that if you can buy a decent man's suit for an ounce of gold, then gold is about roughly fairly valued. So $1,700, I think that's not a reasonably modest good man's suit. I think that's probably an expensive man's suit. So I think gold is a little high right now. Probably won't do too badly, but I don't think there's a lot of upside potential. So for me, what I'm looking at is Bitcoin. As you can see here, Bitcoin has it's sort of somewhat moderately valued, I would argue. It's quite a ways off of its all-time high, where it closed about 17, made it up to about 25,000 at one point, and now it's sitting at around 9,500. So that's something to consider. I'm certainly thinking of putting some of my money into Bitcoin. It's been one of the strongest assets lately, and I can show you this. Okay, so here we can see as a website, and I have all these links below, and you can see how dollar cost averaging Bitcoin has done over the last little while. I'm not suggesting putting all your money into it. At least I'm not suggesting you do anything at all. Actually, I'm just giving you some ideas, just thinking thoughts worth thinking. And again, this is not financial advice. This is just something for you to put in your pipe and have a smoke if you like, and maybe think about what you can do, some options. But for me, this has been somewhat encouraging. So if you put $10 weekly into Bitcoin, just buying $10 worth every week, you accumulate for 3 years, and you started 3 years ago, you'll see that you've done about 51%, which is not bad at all. Now let's see how that compares against the stock market. So for example, we had 51% increase in Bitcoin since that time, 28% in gold. So gold has done well, and of course, unfortunately, the stock market has not done well at all. You're actually down if you were dollar cost averaging. Let's see what happens if we did it for the last year, because things have been a little hairy there. Then you can see that gold has done best, second with Bitcoin, and minus 6% for the stock market. So that's really interesting. You can see that even in this past year, Bitcoin has actually done quite well, as you can see, and this is compared to the Dow Jones Industrial Average. This is the sort of the stock market value they're using. And if we go back just 6 months, to give us really a closer idea, then you can see that Bitcoin has done better in the past 6 months, followed by gold, and then the Dow Jones bringing up the rear. But I think if you're going to get into Bitcoin or digital assets, then you should be looking at the long term. So I would suggest at least give yourself at least a 5-year timeline, and we can see how things are really looking. So Bitcoin has grown 788% in 5 years, followed by gold 34% and just 12% for the Dow Jones. So I think, for the little man, perhaps gold and digital assets are probably the safest relatively approach to invest in. But currently, as I mentioned, the problem with gold is that it's looking a bit rich right now. So I'd probably want to buy it back down around here, at around 1,300 or so. Probably not a bad time, but it could take probably a few years to get down there if it does get down there again. With Bitcoin, for example, you can see that it's sort of in the middle of its chart, about 9,000, about half of where its high used to be. Of course, if it gets down to about 4,000, I think it's a great buying opportunity. I'm not sure if it'll get down there, but even at around 6,500, I think I would consider that another great buying opportunity. Of course, the thing with Bitcoin is risky. It's only been around for about 10, 11 years, so it could arguably go down to zero, and that perhaps shouldn't be surprising, but I think the upside is huge. We've discussed before how Bitcoin could make it to, perhaps $1 million by the end of this decade per Bitcoin. But who knows? This is all speculation. So we'll see. Here's some more information about the stock market. So the Shiller PE ratio, you can see it's pretty much at a third place all-time high. I kind of consider this as sort of a similar period of time, even though now it's at 28.62 and about 30 on Black Tuesday, which was, the great crash, the Black Monday here. And then, of course, the biggest one was the dot-com bubble, which was quite excessive. And then here we had, around here, we had the financial crisis. So it's certainly higher than that. It's arguably, second, third place overall. So I consider the stock market generally a bit rich at the moment. It's one of the things I look at when considering if I should go looking for value in stocks. And then, of course, the GDP to bull share total market, also known as the Buffett indicator after Warren Buffett, considers this a good sort of approach. And here you can see it's currently at about 143% of the GDP, so that's significantly overvalued as well. And lastly, we have David Tepper talking about, says this is the second most overvalued stock market he's ever seen, behind only 1999. 1999, of course, was the dot-com era, and we can see that too from the Shiller PE ratio. Right here's the dot-com era, and so arguably the second most highly valued comparatively speaking. The S&P 500's forward price earnings ratio based on estimates for the next 12 months has ballooned to above 20, a level not seen since 2002. So anyway you look at it, I mean, this is trying to read tea leaves to determine the future, but these are some of the thoughts that I've been thinking. I hope you like them, folks. Thanks for listening. And remember, dumb sparrow, sparrow.